Can you live off dividends? Have you ever dreamed of leaving the 9 to 5 behind and living entirely on your own investment income? Many people hope that dividends can fund a life where you choose how to spend your time. But is it really possible? In this episode of the Simply Investing Dividend Podcast, I'm tackling that question head on. I'm Kanwal Sarai, and today we'll look at the numbers, how much you actually need, clear up some common misconceptions, and map out whether a dividend-supported lifestyle is within your reach. Tune in. This episode could reshape the way you invest and bring you closer to long-term financial freedom. In today's episode, we're going to cover the following 6 topics. What are dividends? Can you live off dividends? How much do you need? How to reach your goal, how to build a portfolio, and then we'll finish off with 2 examples of actual dividend investments. Let's get started with our first topic. What are dividends? Dividends are essentially the profits that a company shares with you, the shareholder. So in this example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you will receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend of $1 per share. You can spend the dividends if you like, or you can reinvest them. The dividends are deposited as cash into your trading account automatically. Now, this is regardless of stock prices. Stock prices can go up, prices can go down, but as long as you own the number of shares, and in this example, 1,000 shares, and as long as the company pays the dividend, you will receive that dividend income. Now let's move on to topic number 2. Can you live off of your dividend income? And that is the big question and the topic of today's episode. And the short answer is yes, it is possible. But first, you need to answer the following 3 questions. How much money do you need? How do you reach that goal? And how do you build a resilient dividend portfolio that's going to give you that income to be able to live off of your dividends? So we're going to cover all of these in the next topic. So let's get started with topic number 3. How much money do you need? Now, this is going to be very personal to your situation. Are you single? Are you married? Do you have kids? A whole lot of different variables. So the first thing you want to do is estimate your costs of living. And so that will include a whole lot of things. I've listed just a couple of examples here. So housing, food, transportation, clothing, insurance, that also includes health insurance, home insurance, car insurance, if you want to be able to travel, health and wellness, maybe a gym membership, gifts for family and friends, charity if you want to donate to charities, education if you want to further your education, entertainment, hobbies, and of course taxes. So there's probably more items in these other categories, but this is just to get you started. So what you want to do is write down what you think maybe your current costs are and what your costs could be in the future, because we need to have a goal in mind, right? We don't want to just build a dividend portfolio to generate any amount of income. We want to design it and build it so that it covers your eventual living expenses. And so, like I said before, the costs are going to depend on your age and also your health, your spending habits, your current lifestyle, and your location. Do you live in an area that's very expensive? So the housing costs are very expensive, transportation costs are expensive, or are you living in an area where things are not as expensive, but maybe, paying for food is more expensive? So you have to consider all of these different factors, right? So this is a very personal number to you. So it's very hard for me to put that into a podcast episode and give you an exact number, because that's going to depend on, like I said, your age, your health, spending habits, where you live, which part of the world do you live in, which city do you live in. So what I'm going to do here is just to keep it simple for today's episode, so that we move on to the next topic. We want to keep it really simple. Let's imagine a very comfortable lifestyle in a mid-sized city in North America, somewhere in the US or in Canada. And let's say your total costs are, and this is an average, it's an approximation of, let's say, $95,000 a year. Now, for some of you, that may seem like a lot of money and you don't need to spend that much. And for some of you, it may seem like it's not enough. And so for you, it's going to be much higher. Maybe it's $100,000, $150,000 a year to live comfortably, to cover all of your living expenses. So like I said, for some of you, it's going to be more. Some of you, it's going to be less. I'm going to stick with $95,000 for now. We want to keep it simple. Just want to give you an example, a goal to reach towards. And of course, it's going to depend with, do you have a partner or a spouse? Are they making some income? Will that help to cover your total living expenses? Absolutely. So like I said, this number is going to be different for everyone, but we're going to move on to our next topic. So for now, let's just say $95,000 a year. And I know some of you are thinking, okay, well, what about inflation? It's going to cost even more. We'll talk about that a little later in this episode, but let's just stick with, for now, $95,000 a year to cover all of your living expenses. So then how do we reach that goal, right? So that's our next topic. How do you reach your goal of making that much income from your dividend portfolio? So to invest successfully, and I've been doing this for over 25 years, there's 3 key things that you need: education, time, and money. So education, you have to know how to invest, what to invest in. How do you look at dividend stocks? Which ones are good? Which ones are not so good? How do you know when to sell? So there is that knowledge piece. Without that knowledge, you can have all the time in the world and you can have all the money in the world, but you may not invest it properly. So you have to have that education, and that's key number 1. So that's where Simply Investing comes in. You can learn from us, from Simply Investing. I'm going to talk about the Simply Investing course towards the end of this podcast. So the fact that you're watching this podcast, this is a great step forward. We have more than 120 episodes now, all educational episodes, all around dividend investing. So I really recommend you go back and watch if you haven't seen the previous episodes. So the education piece is going to be covered from Simply Investing, right? We're going to provide you with that knowledge and education on how to invest. Now let's take a look at the other 2 pieces, time and money. So I'm going to give you 2 examples. We're going to fictional examples. So let's say we're going to look at Jack and Jill, and we're going to assume they're twins, same age, and Peter and John are also twins, same age. So let's take a look at Jack and Jill first. And again, we're going to first look at time, and then we'll take a look at money, how that factors in to your investing success. So the importance of investing early is so key to everything that we talk about. And you can see it here on the screen. And if you're watching this, you can see the slide up on the screen here. Jack and Jill are the same age, but Jack started at the age of this is wrong. As you can see, Jill started investing early. She started investing at the age of 35, and she invested $25,000 into her portfolio, and that's it. Didn't invest any more. We're keeping this example simple, so it's a lump sum amount of $25,000 at the age of 35. Jack waited 10 years to start investing. So he started investing at 45, at the age of 45, the same amount of money, $25,000. And you can see that by the time they both reached the age of 55, Jack had accumulated his portfolio value was $77,219. Jill, on the other hand, her portfolio was worth over $241,000. So that is staggering, the difference between the two portfolios at the age of 55. So you can see that Jill ended up with way more money, even though both Jack and Jill invested the same amount of $25,000 each. So this is just to illustrate the importance of investing early. The sooner you get started, the better off you're going to be. And that's going to allow you to ride out any market downturns. Stock markets go up and down all the time. Stock markets could go down, we don't know, next week, next month, or next year. And then we don't know how long it's going to last. Is it going to last 6 months? Is it going to last 2 years? So if you have a long-term perspective, a long-term time horizon, then you are not too concerned when markets go down, and you can ride out those market downturns. Now let's take a look at the next piece, which was money. And of course, it sounds simple. The more you have to invest, the more money you'll make. Why is that? Because if you've got more to invest, you can buy more shares. And the more shares you own, the more money you'll get in dividends, if it's a dividend-paying company. So let's take a look at Peter and John. Again, both twins, same age. They both, in this scenario, both of them started investing at the same age, at the age of 35. Peter invested $50,000, a lump sum, and John invested $75,000. So John invested a little bit more. Now let's take a look at, by the time they reached the age of 55, you can see it up on the screen here. Peter, who invested $50,000, is now sitting on a portfolio that's worth over $482,000. John, who invested $75,000, is now sitting on a portfolio that's worth over $723,000. Again, that is a huge difference. Look at the portfolio growth, right? Look at how much more John ends up with. And you can see he invested $25,000 more. But this example, that's what we're showing here, is to illustrate that the more you invest, the more money you can make. So keep that in mind. We've got 3 things to be successful. Education, and that's where Simply Investing can help you. Time, you want to start as early as possible. And money, the more you invest, the more you can make. Now let's take a look at a case study of course, I'm changing the name of the individual. We're changing their sort of job title. But we just want to show you and illustrate the example of investing with knowledge, investing with time on your hands, and investing with more money. So Anne is a 35-year-old working professional. She's a software manager. She's got 13 years of professional experience. She's currently making a salary of $160,000 a year. And across all of her accounts, and in this case, it was a Canadian client, so we have an RSP, which is equivalent to a 401k. She also has a TFSA account, which is going to be similar to a Roth IRA if you're in the US. And she also has a non-registered account. So these are all trading accounts, investing in dividend stocks. So she's got $550,000 across all of the accounts combined. Now, she's 35 years old. She wants to keep working, enjoys her job and wants to keep working. And she continues to contribute $350 a month towards her retirement. So an additional $350 a month is going into her retirement accounts. So now let's see what that looks like. What I'm going to show you on the screen here, there's a lot of numbers, so don't worry about that. This is a spreadsheet. It's a Google sheet, which I'll put a link down below in the description. I highly recommend you take a look at it. You can download it. There's no cost, and you can put in your own numbers. And your own numbers are the ones that are highlighted in green. So we have a starting balance. So this is as of this recording, the year 2025, year 1, starting balance of $550,000 in the case of Anne. I highly recommend you put your own number in there. Take a look at all your investments that you currently own, and you can put your starting balance. And then additional investments. Remember, we said she's going to put another $350 a month. So that's $4,200 a year of additional investments each year into her investment accounts. And then I'm going to move over to the right. The other two numbers that are in green, the dividend yield, I put an average of 3.5%. You can adjust that if you like, or you can leave it at 3.5%. Stock price growth, this is also includes dividend growth. So we kind of put all that into one. So I kept it at 8.5%. If you look at any of the literature, you'll see that over the last 70 years, the stock market has returned anywhere from 8 to like 12% or 11%. So I put an 8.5. If you want to put a lower number, you can. If you want to put a higher number, you can do that as well. And that's it. Those are the two numbers that you can adjust. Everything else, the spreadsheet is going to calculate for you automatically. So now in this example, we want to keep it simple. So we're going to assume it's the beginning of the year, 2025. And so Anne has put her money into an investment account. They're all invested in dividend stocks, and I'll show you how we're going to do that when we build a portfolio. And so in the first year, she can expect to earn $19,397 in dividends. And then, of course, we have the value of the stocks themselves. The value is going to go up, like we said, 8.5%. So the value of the stocks goes up. Plus, we add the dividends in there, and you can see the ending balance at the end of the year is going to be $620,704. We take that ending balance and we put it as the starting balance for year 2. Okay, so the spreadsheet does that automatically. And again, she's investing $350 a month as additional investments. And then you can see the dividends. In year 2, she's going to make a little bit more. She's going to make $21,871 in dividends. And then we're going to continue. We're going to go all the way down till 20 years from now when she is 55 years old. So you can see all of the numbers here. Kind of interesting if you look at the dividends earned annually. In 20 years, the total, if you add up all the dividends every year, it's going to add up to over $1.4 million in dividends. Now, of course, she's reinvesting those dividends every year, and so that helps to grow the portfolio. A couple of things I want to highlight here. You can see that by year 6, her portfolio is already worth over $1 million. So that's pretty good growth. And remember, we said our goal was $95,000 a year. That was to reach that goal. That was our living expenses, annual living expenses. So you can see that in year 15, so by the time she's 50 years old, she will be making over $99,000 a year annually in dividend income. So she's exceeded her goal of $95,000. So she could potentially retire at the age of 50. And you don't have to work till the age of 65. Saved yourself 15 years. You can retire early at the age of 50 and become financially independent. Now, some of you are thinking about inflation, and it's gonna cost more than $95,000 a year to live off of. Sure. If we look down to the last row, you can see that by year 20, in the year 20 years, from now, so by the time she's 55, the portfolio will be earning over $176,000 a year in dividends. So I'm sure that covers the cost of inflation, and the dividends will continue to grow. So I've been doing this for over 25 years. The companies that we invest in grow their dividends. And in fact, I've done a previous episode. If I can find the episode number, I'll put it in the description below. You can beat inflation with just the dividend increases alone. So they will take care of the rising costs of living. So this is just an example. Again, I recommend you go in, download the Google Sheet. You can put your own numbers in there because your own numbers are going to look very different. But I'm hoping they're going to motivate you to start investing sooner and to start investing as much as you can, because that's going to help you to reach your end goal. Now let's take a look at how to build your portfolio. The key here is slow and steady with patience and discipline. Why? It's going to help you avoid panic when markets drop. Okay, that's important. So you got to have the discipline to stick to the strategy. It's going to help you to avoid jumping from one strategy to the next. So have the discipline to stick to this strategy and have the patience not to panic when stock markets drop. In fact, sometimes they represent good buying opportunities. So how do you get started? A couple of things to keep in mind here. Dividends are important. Of course, you're listening to the Simply Investing Dividend Podcast, so you know we're going to talk about dividends. I've been a dividend investor for over 25 years, so dividends are absolutely important here. We want to take a look at quality companies, and then the price that you pay for stocks is very important. So let's take a look first at the dividend piece, and then we'll take a look at the other two. So I'm going to give you an example here. We're a company A and company B. Let's assume they're in the same industry. You've got $25,000 to invest. Do you put all that money in company A or do you put it in company B? Well, let's take a look at the dividend yield. Company A has a dividend yield of 5%, which means 5% of what you invest comes back to you as in the form of dividends, as cash. So company A, if you invest that money in company A, you're going to get $1,250 a year as dividends. Company B has no dividend income. So you can see the yield is zero and the annual dividend income is zero because they're not paying a dividend. Here's the thing. Eventually, and that's what we're talking about in this episode, eventually dividends can cover your living expenses. Without the dividend, you're only hoping for the stock price to keep going up. And hope is not going to cover your living expenses. So if you invested all that money in company B, you're only hoping and praying that by the time you retire or by the time you become financially free, like you want that money to live off of, that the shares in company B are going to be worth more than what you paid for. That may or may not be the case. If we end up with a market crash or a market downturn, those shares could be depressed for a very long time. Whereas company A, you get paid for holding on to your shares. So this is an example of why dividends are important. So in this example, all things considered equal, company A would be a better investment. Now let's take a look at quality companies. So I'm just going to give you a quick example of the difference between a quality company and a company that's not a quality company. So let's take a look at this. We got two other companies here, company C and company D. They both pay a dividend of $1 per share. Which one do you invest in? Let's assume they're in the same industry. Everything else is the same. Which company do you invest in? Company C has a debt of 5%. Company D has a debt of 500%. So right away, you can see all things considered equal, company C is going to be a better investment. Why? Because when there's a market downturn or interest rates go up, company D is going to have a very hard time servicing that debt. And we don't want to invest in a company that's going to have a hard time servicing its debt, because then they're going to have to cut their dividend, their earnings are going to drop, and they're going to get into some financial trouble when the markets go down. Company C has very little debt. It's a much more financially healthy company. Again, assuming all things considered equal. So looking at this tells me that company C is a higher quality company from a financial perspective than company D. Let's take a look at one more here. Again, we're going to stick with company C and D. The dividend is the same. Company C, in this example, I'm changing the sector here. It's a different example. It runs a chain of retail grocery stores, so they're in the food industry. Company D is a car manufacturer. So let me ask you this. If there's a recession, or there's a chance there's going to be a recession coming, are you going to go out and buy a brand new car? Of course not. You're going to keep the one you have, or you're going to look at other public transportation or other ways of getting around. You're not going to spend a whole lot of money on buying a brand new car if there's a chance you may lose your job, or if there's a chance that, the recession is coming. So company D, in this example, is not a recession-proof company. And so again, that's another quality metric we want to look at. Is the company recession-proof? Now let's take a look at the price you pay for stocks. And that's very important. So you could have a quality company. The company could be paying dividends, but what is the price that you're paying for those stocks? So now we're looking at two other companies. We have company ABC, company XYZ. They're both paying the same dividend of $1 per share. Company ABC is trading at $25 a share. Company XYZ is trading at $200 a share. So which one do you invest in? To help you make your decision, let's take a look at the dividend yield for both of these companies. You can see here on the screen the dividend yield for company ABC is 4%. The dividend yield for company XYZ is 0.5%. So which company do you invest in? So you can see here that company XYZ is trading at a much higher stock price, and that higher stock price is reducing your dividend yield. So if you were to invest even $1,000 in each of these companies, company ABC is going to pay you a much higher dividend. Why? Because you're going to be able to buy more shares. Because they only trade at $25 a share, you can buy more shares. Even though the dividend is the same for both companies, you're going to make a higher dividend income with company ABC. So it's important what you pay for those shares, right? Everybody says buy low and sell high. And that's the reason why. If you can buy it at a low price, you can buy more shares, you get more in dividends. There's no point in buying shares when they're very high, because if if a company is $50 is overvalued, it's priced high, there's no point in paying $50 for those shares because the likelihood of them going even higher is very low. So it's important the price you pay for those shares. I highly recommend you go back and watch episode 1. I go into more detail and I show you exactly in episode 1 how to figure out when a stock is priced low and how to figure out when a stock is priced high. So I highly recommend go back and take a look at episode 1. So these are the 3 things that we covered in this section. Dividends are important. Why? Because they provide income while you hold on to those shares. Quality companies provide stability. When markets go down, quality companies are able to survive those market downturns a lot easier, or easily, I should say. And the price you pay for stocks, it's going to mean higher income for you in terms of dividends and higher capital gains, because you're buying a stock when it's priced low and you can sell it when it's priced high. So our key here is to invest in quality dividend paying stocks that are priced low, meaning they're undervalued. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock and if it's priced low? So for that, I've created what I call the 12 rules of Simply Investing. You can see them up on the screen here. The way it works is a company has to pass all of the 12 rules before you invest in it. If it fails even one rule, skip it, move on to something else. Now, we've covered some of these just a couple of minutes ago in our slide when we talked about looking at quality companies. So let's take a look here. Rule number 1, do you understand how the company is making money? If you don't, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? And we talked about that in our example just a few minutes ago. Number 5, is it profitable? Number 6, does it grow its dividend? Number 7, can it afford to pay the dividend? Number 8, is the debt less than 70%? And again, we looked at that example just a few minutes ago with a company that had a debt of 5% versus a company that had a debt of 200%. Rule number 9, avoid companies with recent dividend cuts. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? And like I said, we covered this in detail in episode 1. And then rule number 12, keep your emotions out of investing. And when you put all of that together and you stick with patience and discipline and stick to the 12 rules, then you can start seeing the kind of numbers that we were looking at in our case study with Anne. So this is somebody who's starting with $550,000 invested at the age of 35. By the time they get to 55, the portfolio should be worth over $5.4 million. Now, there's a couple of misconceptions I wanted to cover here. Number 1, people will tell you that dividends are not guaranteed, and that's true. Dividends can get cut at any time, or dividends can get reduced at any time. Number 2, people will say, well, I'm going to lose money when markets drop. And number 3, I can't make enough money with dividends. So let's take a look at all 3 of these quickly. So number 1, dividends are not guaranteed. Correct. However, there are companies, and I'm going to show you 2 examples in this episode of companies that have had consecutive years, more than 30 consecutive years of dividend increases. So yes, dividends are not guaranteed, but when you look at companies, even like Coca-Cola, that has over 55 years of consecutive years of dividend increases, you can have a high degree of confidence that next year you're going to get a dividend, and hopefully the dividend's going to go up. And we cover a couple of other things, and I'll refer you to episode 4. Go back and watch that, where I cover your top 3 dividend concerns. Number 2, people say, well, I'm going to lose money when the markets drop. Well, only if you sell. And when the markets are down and prices are down, that is the worst time to sell, because then you solidify your losses. If you don't sell, you haven't lost anything yet. And as dividend investors, you're still collecting dividends. So I'm going to recommend you go back and watch episode 36, where I talk about investing versus speculating. There's a complete difference between the two. And if you're speculating, yes, you're going to lose money when markets drop. If you're investing responsibly, then you'll be fine. Follow the 12 rules and be patient and have discipline. Number 3, people will say, well, I can't make enough money with dividends. Some of the companies pay dividends of like 75 cents a share, $1 per share. I can't get rich off of that. That's not enough money in there for me. Well, for those of you, I recommend you go back and watch episode 7, where I talk about real life examples of extraordinary returns with dividend stocks. And hopefully that'll motivate and inspire you to get started on your dividend journey. Now let's take a look at our last topic in today's episode. I'm going to give you 2 examples of dividend stocks. So we're going to look at 2 companies, Clorox and Ecolab. Clorox was founded in 1913, headquartered in Oakland, California. They have 7,600 employees and a market cap of $13 billion. You may know the name. The company manufactures and markets consumer and professional products worldwide. Ecolab was founded in 1923, headquartered in St. Paul, Minnesota. 48,000 employees, market cap of $77 billion. So a much larger company. But I thought it'd be a great example here to show you sort of a very large company and a smaller company. Ecolab provides water, hygiene, and infection prevention solutions and services in the United States and internationally. So in this example, we're going to imagine that you have $10,000 invested in each company back in 2005. So that's 20 years ago. and you just kept the money in, you invested in both companies and you held on to those shares. So fast forward to now, what does that look like? Was that a worthwhile investment or not? What does the dividend income look like? So again, I just picked these as examples, right? I know people go back to 2005 trying to figure out. I'm not sure. I don't have the data to go back to 2005 to tell you if the company, these specific two companies, passed the 12 rules of Simply Investing or not. What's important here is to show you the power of compounding, the power of the dividends growing and the stock prices going up. And these are dividend payers. These are companies that have been paying dividends for more than 3 decades. And so it's to illustrate the power of dividend investing. All right, so that's it. And we're keeping the numbers simple just so that it makes it easier to follow. So let's get started. $10,000 invested in each company in 2005. So you can see here, Clorox, $10,000 back in 2005. Same with Ecolab. Dividends received since then. With Clorox, you would have received over $11,100 in dividends, which is incredible. That's great. You invested $10,000, you've already made your money back, right? So if the stock price goes down, you're not going to be losing any money. You've already made your money back in dividends. So everything else after this is just pure profit. Ecolab, getting closer, but has not exceeded the $10,000 in dividends. Nevertheless, $8,277 in dividends received since 2005. So if we look at our investments put together, so your total investment in this example of $20,000, you would have received $19,417 in dividends. So that's good. That's really good. We're getting close to our initial investment. Your initial investment will be paid off. Everything after this would be just pure profit. So that's good to know that the dividends are coming in and they're growing. Now let's take a look at your current annual dividend income from both of these investments as of this recording. So you can see that Clorox is generating $863 a year in dividends. So represents an 8.6% dividend yield on cost, which is based on your purchase price. And Ecolab, $782 a year in dividends, so that's 7.8%. If we look at this as one portfolio with two companies, this portfolio is generating $1,645 a year in dividend income. So that's a return of 8.2%, which is pretty good. Some companies will have a dividend yield of like 1%, 2%. Putting money in a bank account, you're not going to get that much in interest. Even a term deposit, you're not going to get that much in interest. And here you're making over 8% a year just for holding on to those shares. Now let's put it all together. We're going to take a look at the total return, including all of the dividends received over the years. And you can see that Clorox represents a return of 199% since 2005. Ecolab represents 813% return. The investment alone in Ecolab, remember it was $10,000 invested, today would be worth over $91,000. Clorox, you invested $10,000, today would be worth almost $30,000. So the total, again, as a portfolio made up of these two companies, $20,000 invested back in 2005, today would be worth over $121,000, representing a return of 506%. So that's pretty good. It's a good return. These companies are paying dividends, and they continue to not only pay dividends, but to increase them year after year. Take a look at this. Clorox has had 46 years of consecutive dividend increases. Ecolab has had 33 years of consecutive years of dividend increases. Think about how many market downturns we've had in the last 33 years or 46 years, how many market crashes we've had in the last 3 decades, but yet These companies, just these two, and there's lots of other companies like them, have not only paid a dividend to the shareholders, but also increased their dividend year after year after year. So this is what's going to give you stability in your portfolio, even when markets go down. And it's going to give you predictable income that you can rely on in the future. Now, sure, there might be over your investing lifetime, one or two companies that may cut the dividend or reduce the dividend. Overall, your portfolio will do fine. The likelihood of you picking those stocks, if you applied the 12 rules, is extremely low. I've gone through the 2008-2009 financial crisis, the COVID in March of 2020. Both of those time periods, the markets tanked. A lot of companies reduced their dividend, but yet my dividend income went up every single year over the last 25 years. So our approach to investing is to keep it simple. We help you build a resilient portfolio that provides you with growing dividend income each year. How do you do that? You invest in quality dividend-paying stocks when they're priced low. And how do you know that a stock is priced low and it's a quality stock? Follow the 12 rules of Simply Investing. The rules are designed to lower your risk, save you time, and help you earn more. So here again, you can see the 12 rules on the screen. I'm not going to go through them again because we just covered them in today's episode. We have an all-in-one solution. We have a Simply Investing web application or the platform, and we have a Simply Investing dividend course. So the Simply Investing web application applies the Simply Investing criteria to over 6,000 companies in the US and Canada every single day, and you can immediately see which companies pass the Simply Investing criteria, which ones fail the Simply Investing criteria. So it's going to save you a lot of time. It's going to show you which companies to focus on and which ones to avoid. The Simply Investing Dividend course is an online course. It's a video course. We've got 10 modules. In Module 1, we cover the investing basics. Module 2, we cover the 12 rules of Simply Investing in detail. Module 3, I show you how to apply those 12 rules to any stock anywhere in the world. Module 4, show you how to use the Simply Investing web application. Module 5, you learn how to place your first stock order step by step. Module 6, how to build and track your portfolio. Module 7, you learn, when to sell, which is just as important as to know when to buy. Module 8, how to reduce your fees and risk, especially if you have mutual funds, ETFs, and index funds. Module 9 will give you your action plan to get started right away. And Module 10, we answer your most frequently asked questions. The all-in-one solution, if you're interested, you may want to write this down. We have a coupon code, SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's episode, be sure to hit the subscribe button, hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.